The financial management section of the ESB exam will expect you to know how to interpret basic financial statements, understand credit ratings, identify fixed and variable expenses, know the factors that influence the price of goods, analyze cash flow and create an appropriate budget, and identify the break-even point for a business. Let's take a look at scenarios involving financial statements. We'll start off with a little matching.
To which category do the following assets and liabilities belong? Scrolling down our list of assets and liabilities, bank loans would fall into the liabilities category, but are they current or long-term? Reading the rest of the list, we see mortgage payments, also a liability, and a long-term one at that, so our bank loans would fall into the current liability category. On the asset side, we have inventory as our current asset and equipment as the long-term asset. How about another? To which category do the following costs or expenses belong? For this one, categories may be used more than once or not at all. Going down the list, rent is an operating expense, sales generate revenue, labor falls into the cost of goods sold category, as do materials. That leaves insurance and advertising, both of which are operating expenses. Marcy, the owner of a pizzeria, wants to know the book value of all the equipment in her restaurant at the end of the year. On which financial statement would Marcy find this information? Of these options, only one summarizes the assets and liabilities, as well as the available capital, for a specific time period, and that is the balance sheet. That's where Marcy should look to see the book value of the equipment in her restaurant.
Here are a few scenarios that ask you to use a form, worksheet, or example financial statement to answer the question.
Jade is reviewing the income statement for her cafe, specifically looking at net sales, total cost of goods sold, gross profit, total expenses, and pre-tax and net profit. Your task is to use her income statement to determine the appropriate location of the following figures. Let's calculate the net sales. Simply add gross sales and sales returns for $20,997. Subtract the total cost of goods sold from the net sales to get $17,057 in gross profit. Multiply 7,657 by 0.29 to calculate $2,221 in taxes. And finally, subtract the taxes from the pre-tax profit for a net profit of $5,436. Isaac is inspecting the income statement for his recording studio, analyzing his net sales, total cost of goods sold, gross profit, total expenses, and pre-tax and net profit. Using his income statement, determine the appropriate location for the following figures. Like before, let's begin by calculating the net sales. Add gross sales and sales returns for a total of $35,750. Subtract the total cost of goods sold from the net sales to get $27,400 in gross profit. Multiply $3,730 by 0.33 to calculate the $1,231 in taxes. Finally, subtract the taxes from the pre-tax profit for a net profit of $2,499. Eli is analyzing the income statement for his home painting business. He's investigating net sales, total cost of goods sold, gross profit, total expenses, and pre-tax and net profit. Determine the appropriate location of the following figures using his income statement. One more time. Calculate the net sales. Add gross sales and sales returns for $48,775. Subtract the total cost of goods sold from the net sales to get $33,450 in gross profit. Multiply $10,400 by 0.3 to calculate the $3,120 in taxes. Finally, subtract the taxes from the pre-tax profit for a net profit of $7,280.
Okay, so why did we look at three scenarios that were asking the same thing? Well, simply to show you that regardless of the language used in a scenario like this, it is the task that is important. Also, you may find on the ESB exam that you are asked similar questions multiple times. In the credit rating section of the exam, you'll be asked to identify the factors that influence credit ratings, as well as the importance of having a good credit rating.
Sean is looking for a loan to expand his business. The loan officer at the bank asks Sean to fill out a form that asks for information about his income, bank accounts, credit cards, outstanding balances, whether or not he rents or owns, and other information. The loan officer lets him know that as part of the application that the bank will be requesting his credit score. Of the following, which three factors will affect Sean's credit score? Remember, credit scores are affected by payment histories, amounts owed on accounts, how long an individual has had credit, how many accounts an individual opens, and what types of credit an individual has. Knowing that information, we can quickly point to Sean's payment history, how much he owes, and the lines of credit he currently has as the factors that will affect his credit score.
Here are two scenarios that will ask you to understand why an entrepreneur's loans might be approved or denied.
Chris decides he wants to sell new ATVs or OHVs in addition to owning his existing repair shop. He goes to the bank to apply for two loans. The first loan is for the purchase of an inventory of ATVs and OHVs for the showroom. The second loan is for operating costs, covering rent of the new space, payroll, utilities, etc. for the first 2 months. The bank tells Chris that they will likely approve the first loan, but not the second. Why? Based on the information presented, we can easily eliminate the first and fourth options. We aren't given information on whether or not the operating loan would be unsecured or about interest rates. You might be tempted to infer that 2 months is too short of a term for the bank to make money on the loan, but we aren't given detailed information about either loan's terms. Therefore, the best answer is that the inventory loan would have collateral, the new ATVs and OHVs purchased for inventory, while the operating loan would not. The owner of CarMax Bakery is applying for a loan to purchase a larger space for his bakery. As part of the loan application, the lender reviews the owner's credit history, which reveals some items. Ultimately, the loan is denied. Which item from the owner's credit history caused the denial? The years of operation are long enough to determine strong cash flow, so we can remove the first and fourth items. The outstanding $42,000 loan might have been a cause for concern, but ultimately the lender knew that the furniture and equipment could serve as collateral. But the owner's low credit score was the big red flag that ultimately led to the denial of the loan.
Identifying what constitutes a fixed or variable expense is another task you'll need to be prepared to do. Let's take a look at how you might be asked to do just that.
Determine whether the following are fixed or variable costs. Products sold to customers is a variable cost. A weekly newspaper ad and a monthly lease fee for a credit card machine are both fixed costs. You might be tempted to classify the credit card processing as fixed, due to it being a consistent 2%, but it is 2% of the purchase price, which makes it a variable expense.
Try a couple scenarios about expenses on for size.
Tyler has become successful with his online business specializing in unique merchandise relating to TV and film. He's refined the business so that he is drop shipping orders to his customers directly from his suppliers. Which of Tyler's expenses is variable? Careful reading is required here as we have two excellent possible answers, shipping and inventory costs. However, based on the information in the scenario, we can see that Tyler doesn't carry any inventory. He is relying on his suppliers to manage inventory. That leaves us with shipping costs as Tyler's variable expense. Rick owns a successful home remodeling business. Into what category do these expenses fall? Material will vary from job to job, so that is a variable expense. The exam fee would be classified as a fixed expense. Travel is certainly variable. Building permits also vary based on the complexity of the job.
In some scenarios, like Rick's home remodeling business, it might feel like you're being asked more about a specific business than about expenses. Like I've said before, don't overthink the scenarios and let common sense and critical thinking be your guide. The pricing section of the exam will ask you to identify the factors that impact price to a customer. Let's take a look at a few scenarios.
Jason's training business has grown exponentially. The business now occupies a small campus that includes a large green space at the center of the campus where Jason has put several putting greens for use by the staff. He's been reviewing expenses versus income for the last 6 months and noticed that the city had recently increased rates for water and sewer. All other costs, maintenance, salaries, equipment, remained as expected. Jason determines that he must raise the fees for his company's services. Of the following, which is Jason concerned with? Due to the changing rates his company is charged for water and sewer, Jason is concerned about variable costs.
Did you like how you had to use your knowledge of fixed and variable costs and how they might affect pricing? Here are a couple more scenarios.
Marcy has used the fact that she uses locally sourced ingredients for her pizzeria to help differentiate her restaurant from JD's Pizza Place. A recent law passed that increased the minimum wage from $8 to $12 per hour. Marcy has been forced to raise the average price of her offerings by 30%, and customers are complaining. Which two factors are responsible for the price increase? Quick scan of the list, we can see that separation costs don't apply in this scenario, and there is no mention of an increase in rent or utilities. That leaves 3 possible answers. Increased labor cost is certainly a contributing factor, as Marcy now must pay some of her employees a higher wage. Of the remaining 2, you might be tempted to choose loss of customers, but loss of customers, though only implied, would occur after the price increase. That leaves increased raw material costs. Why would they have gone up? Well, remember, she buys locally sourced ingredients. Her suppliers are subject to the same minimum wage increase as she is, and would be passing along their increased cost of business to their customers. A service station advertises 2 prices for all grades of gasoline. Cash prices are about 15 cents less per gallon than credit card purchases. For what reason would the service station charge more for credit card purchases on fuel? While the first 3 are plausible answers, in varying degrees, offsetting the fees the station is charged by credit card companies is the best answer.
In the analyzing cash flow section of the exam, you'll be presented with scenarios asking you to identify and analyze cash flow. You'll likely be asked about accounts receivable, accounts payable, inventory, and debt. Let's take a look at a few scenarios.
Carla arranged for a loan from a friend to purchase some upgraded equipment and supplies. After discussing terms, they agree on a 1-year term and an annual simple interest rate of 6% on the $8,400 loan. At the end of 12 months, how much simple interest is due? We have two possible answers based on the numbers in the scenario, but the question wants to know how much simple interest is due, $504, and not the total amount due at the end of the term. Trey is reviewing the previous year's cash flow for his dog walking business. His beginning inventory balance of leashes, shoes, treats, dog run, and other items was $700. New inventory purchases were $480. $375 of inventory items were provided to customers. Of the following, which is the ending inventory value? Let's add the existing and new inventory values together. 700 plus 480 is 1,180. Subtract the $375 worth of inventory provided to customers, and we have an ending inventory value of $805. Xander has been running a small but successful bike shop for the past 4 years. He's been reviewing his cash flow for the previous year. He started the year with a $40,800 inventory balance. A total of 82 bikes were added during the year at an average price of $1,200 each. $104,400 worth of bicycles were sold by December 31st. What is the ending inventory value? To determine the ending inventory value, we first need to determine the total inventory value. Xander started with $40,800. He added 82 bikes at an average of $1,200 each for a total of $98,400. Add that to our beginning inventory value for a total inventory value of $139,200. Subtract the inventory sold, $104,400, and we get $34,800 as the ending inventory value. Shannon owns a small herb and vegetable farm and a greenhouse that supplies ingredients to local restaurants. She's preparing the cash flow statement for her first year of operation. Her beginning cash balance was $2,900. Her total cash sales were $23,790. Fertilizer and equipment costs were $820. Utilities was $1,200. Loan payments was $1,800. Marketing, packaging, and delivery was $3,100. And other fees were $475. Of the following, what is Shannon's ending cash balance? First, total the cash balance and cash sales. $2,900 plus $23,790 equals $26,690. From that total, subtract total costs. Total costs, $820 plus $1,200 plus $1,800 plus $3,100 plus $475 equals $7,395. Subtract that from $26,690, and we have an ending cash balance of $19,295.
Remember not to concern yourself with the plausibility of the values you may be given to work with. Some scenarios will be more believable than others. Just work with the information you're given. Let's take a look at how you might be asked to create a cash flow budget.
Janine owns a real estate office and has prepared a cash flow budget for the upcoming month. Her beginning cash balance is $1,725. Her projected revenue is $7,200, and costs are $850 in supplies, $3,100 in payroll, $875 in rent, and $120 in insurance. What are the dollar amounts that belong to the following categories? The cash inflow is the projected revenue of $7,200. The cash outflow is the total of the expenses, so $850 plus $3,100 plus $875 plus $120 equals $4,945. The available cash is the projected revenue and the beginning cash balance, so $7,200 plus $1,725 is $8,925. The ending cash balance is the available cash, $8,925, minus the cash outflow, $4,945, which equals $3,980.
Michael is putting together the cash flow budget for the coming month for his landscaping business. He projects they will complete 120 client jobs for an average of $60 per job. Dumpster rental and haul away will total $200, gas $310, insurance $80, and payroll will be $3,880. If his beginning cash balance is $1,855, which of the following will be his ending balance? First, let's total the available cash. 120 jobs at $60 each is $7,200. Add the beginning balance of $1,855 for a total of $9,055. Total the expenses, $200 plus $310 plus $80 plus $3,880 equals $4,470. Go ahead and subtract that from the available cash, $9,055, and you have a $4,585 ending cash balance. A parasailing company has an ending cash balance of negative $16,425 at the end of April. For May, the company forecasts the following cash inflows and outflows. Of the following, what will be the company's beginning cash flow in June? Like you've done before, add up the revenue. $440,800 plus $290,000 plus $41,600. Don't forget to include the cash balance from the previous month of negative $16,425. Remember also that numbers in parentheses indicate a negative value. That gives you a total of $755,975. Do the same for expenses. $165,500 plus $230,000 plus $87,000 plus $58,000 plus $86,000 for a total of $626,500 in expenses. Add the two totals and we have a $129,475 beginning balance for June. Remember to keep in mind all the expenses and revenues when creating your cash flow budgets. It's easy to forget the previous month's ending cash balance when it is given before the rest of the expense or revenue data. In the break-even section of the exam, you'll be given various scenarios where you'll have to determine the break-even point for a business or determine what values apply to a formula to calculate the break-even point.
Trey charges $15 for each walk he takes a dog on. The total cost for running his business per month is $1,680. How many dogs does Trey need to walk to break even each month? This one is straightforward. Simply divide the total cost by the amount charged for each walk. $1,680 divided by $15, which equals $112. Any number above that would yield a profit, so neither 115 nor 120 would be the appropriate answer for the question posed by this scenario.
Here's another.
Spencer's plumbing business has fixed costs of $1,800 per month. His only variable costs are for labor and supplies. The average variable cost is $90 per repair, and the average paid by customers per service is $135. How many repairs will Spencer need to break even for the year? First, let's figure the fixed cost for the year. $1,800 times 12 months is $21,600. Then determine the net gained per repair, $135 paid per repair minus $90 of cost per repair for a net of $45 per repair. Divide the fixed costs by the net earned, $21,600 divided by 45, which equals 480 repairs required during the year for Spencer to break even.
Let's switch things up for the next scenarios.
Leslie wants to open a flower shop. After a little due diligence researching competitors in the area, she estimates she can charge an average of $25 per flower arrangement. Leslie wants the shop to break even within 1 year of opening. She needs an estimate of her fixed and variable costs and the number of purchasing customers, or units, required to break even. Given the following costs, what are the correct values for this formula? Fixed cost divided by average price minus variable costs. That will equal our break even in units. First, add the fixed costs: rent, utilities, internet, wages, insurance, and equipment, for a total of $117,500. Then add the variable costs for flowers and vases, for a total of $5. Subtract that from the net revenue per sale, and we get $20. With these values, we can now calculate the number of sales or units required to break even. So, $117,500 divided by $20 means that Leslie will need 5,875 sales to break even in her first year. Neil and Brenda want to open a takeout pizza place called Blackjack Pizza to rival JD's Pizza Place. Their concept is that they will only sell large gourmet pizzas. They plan to sell each pizza for an average price of $21 each. Their goal is to break even in the first year of operation. They'll need to estimate their fixed and variable costs and the number of pizzas to sell, or units, to achieve their goal. Given the following costs, what are the correct values for this formula? Fixed costs divided by average price minus variable costs equals break even in units. Like before, add the fixed costs of rent, utilities, internet and phone, wages, insurance, and setup cost for a total of $365,800. Then calculate the variable costs, dough, meat, cheese, sauce, and toppings, for a total of $5.50. Subtract that value from the gross price per pizza for a net revenue of $15.50 per pizza. Plug the numbers into the formula. $365,800 divided by $15.50 equals 23,600 pizzas required to break even in their first year. Neil and Brenda better get cooking.
The exam may throw you a curveball and give you various values to choose from to complete break-even formulas. Be careful. These values will be based on the information you are given, meaning incorrect answers will be plausible. So be sure you understand how to appropriately determine what is a fixed or variable cost and how to generate a net value, and you'll be well prepared. The best advice I can offer for the exam as a whole is to be sure you read carefully. The exam isn't out to trick you. All the information you need to answer the questions will be given to you. Apply your knowledge and choose the best answer. Good luck on the ASB exam.